For the week 41, which is from October 6th to October 10th, let's set the stage clearly and quickly. My operating bias is neutral. It is highly subjective because bearish risk concerns are pressing against bullish technical setups, so I want to stay balanced and responsive rather than opinionated. The range focus for the coming week is from 6542 to 6800. That bracket frames the tactical battlefield and helps me decide when to lean into strength and when to fade exuberance. Soft resistance sits at 6800. It is a big round number and likely requires multiple attempts to break, and I expect any push into it to invite profit taking. Soft support is at 6611, which lines up with the lower boundary of the current tight bullish channel and therefore attracts buying interest from dip traders. Hard support is 6542, aligned with the 50-day exponential moving average and a prior range low, which likely draws responsive buyers on first touch. Two macro catalysts are front and center. Consumer Price Index lands on Wednesday and Producer Price Index follows on Thursday. Both reports can compress or expand the range, so I plan around volatility spikes rather than pretending they will be quiet. For Monday, I consider two playbooks. On a gap up, if the open produces two or more consecutive bullish bars, the market may attempt to retest 6800. I favor a long in that scenario, but I will take profits before price gets into the 6800 zone to avoid the crowd that often sells there. On a gap down, if price breaks below Friday's low at 6754, I look for a short and I monitor momentum carefully. I will take profits after the second reversal from bearish to bullish because that can be an early hint of a lower high reversal pattern taking shape. I will keep the chart shown for the weekly executive strip in view so I can align intraday tactics with the larger areas. The takeaway is straightforward. We are trading inside 6542 to 6800 with CPI and PPI likely to shake the tree, so I want to anchor to levels and let the market reveal its hand before pressing, which sets up the broader context for the monthly outlook next. Stepping back to the monthly view, I expect a potential pause in the bullish trend during October before a run toward the target at 74.63. I maintain a bias that the all-time high will likely appear before October 15, 2025, and that timing context shapes how I weigh pullbacks and breakouts. The dominant patterns include a parabolic climax, a move to the top of the channel, and round number resistance acting as a psychological ceiling. The market has been surging with enthusiasm concentrated in artificial intelligence themes. There is little bearish news pressuring the large technology names, yet from a technical perspective current prices look overextended for initiating fresh long positions. That means I prefer to buy pullbacks rather than chase strength at the top of the channel. With 4 weeks remaining in October, a retest of the 6160 to 6230 zone followed by a bounce is plausible given the parabolic behavior that often needs a reset. I respect that outcome without assuming it is guaranteed. Even with the possibility of a pullback, the broader bullish trend remains intact, and from a higher time frame perspective I continue to prioritize long setups over short ideas. In other words, the path of least resistance still points up, but the monthly chart argues for patience on entries. For levels, I keep resistance at 6800 in focus as a key round number and I mark support at 6371, which is the low of the September monthly bar. Those two references help me calibrate whether a dip is a routine pullback inside a strong trend or the first leg of something more complex. I will keep the chart shown for the monthly outlook on my screen while planning risk. The key takeaway is that the monthly trend is bullish but stretched, so I want to buy value on dips and avoid chasing at resistance, which leads directly into the nuance of the weekly outlook. On the weekly time frame, I describe the trend as neutral to bearish, not because the chart looks weak, but because we are testing the top of a trading range where the reward to risk for new longs can compress. Visually, the chart is strongly bullish, and that makes a bearish view difficult to press with conviction. There are no clear signs of classic bearish behavior such as a flattening channel that rolls into a range. Contrast this with the significant drawdown in April, which began from a stair-step channel that telegraphed loss of momentum. Today, the structure still looks like a tight bullish channel. Buyers continue to dominate on dips below each prior bull bar, and sellers often take profits early rather than push through those zones. The uptrend is resilient, and even if we do see a bearish move, the bottom of the channel remains the key support to watch for responsive buying. That said, I never let the weekly picture overrule the realities of intraday tape. The 5-minute chart requires nuance, because higher time frame context provides bias while execution depends on signals that may be counter-trend for short stretches. For levels of this week, I note resistance at 6,800, which remains the key round number magnet, and I mark support at 6,520, which is the midpoint of the broader trading range and the breakout level from a month ago. Those references give me a structured way to decide whether to press, to fade, or to wait. I will keep the chart shown for the weekly outlook in view so I can reconcile any intraday turbulence with the higher time frame. The takeaway is that the weekly picture is still buoyant but near range resistance, so I will be selective on longs and quick to manage risk, which flows naturally into the daily outlook for timing. On the daily time frame, my bias is neutral to bearish. Price is at the top of the bull channel and the latest bar, which can act as a signal bar, closed as a bear bar with a long upper tail. That combination often signals a pause or a pullback attempt. Given the prior analysis of a parabolic climax and the current channel behavior, the probability favors a test of the bottom of the channel before any sustained attempt at new highs. Last Friday printed a shooting star that closed bearish, which raises the odds of a gap down to start the week and opens the door to further downside probing early in the session. Even so, the dominant backdrop remains a strong bullish market where buying pressure repeatedly appears below each bull bar. That is why when I short on the 5-minute chart, I prefer to take profits quickly into those buy zones, especially if I see a second bullish entry signal forming, and then reassess rather than overstay a trade. My main levels are clear. Resistance remains 6,800 and I expect it to act as a psychological barrier on first tests. Support is 6,635 at the bottom of the bull channel, with room for a slightly deeper test around 6,610, which is the low from September 17th. Those references help me distinguish between a routine pullback in a healthy uptrend and a more meaningful change in character. I will keep the chart shown for the daily outlook on hand to align entries with context. The takeaway is that the daily chart suggests a pullback within a strong trend, so I will hunt for high-quality intraday signals instead of overtrading. Let's review the last Monday session. For entry 1, the initial expectation was to place a stop order above bar 3 with a stop loss set below bar 3 and a target of at least 1 times the measured move at 67.36. The actual outcome was a small loss if exiting below bar 20, or a full stop out for a loss of 7.5 points. For entry 2, the initial expectation was a stop order below bar 20 with a target around 6,700 based on 1 times the measured move. The actual outcome reached the target at bar 59 near 6,700, producing a 16-point profit, which fits the Brooks playbook of selling a strong bear breakout and then managing into measured move targets while avoiding late adds. For entry 3, the initial expectation was a stop order above bar 53 to break a bear flag with the protective stop below bar 49 and a target at the prior bearish breakout area around 67.15. The actual outcome hit 6,715.25, yielding about 6.25 points, which reflects the tendency for the market to test breakout points even inside a range. Across these trades, the lesson is classic price action. Focus on the quality of the signal bar, respect context, and take partials or trail near measured move objectives. I will keep the chart shown for the Monday review nearby for pattern recall. The takeaway is that Monday rewarded patience and measured move discipline. On Tuesday, the plan leaned on trading range structure with higher time frame bullish momentum supporting by attempts near the bottom of the range. For entry 1, the initial expectation was a stop order above bar 15 with a stop below bar 15 and a target of at least 1 times the measured move at 6,709 or the top of the trading range at 6713. The actual outcome achieved 6,713 and booked about 11 points, which aligns with the Brooks concept that in a range, the top and bottom are magnets. For entry 2, the initial expectation was a limit order around or below the low of bar 15 with the actual fill at bar 24, based on the idea that persistent bullish momentum on a higher time frame supports buying pullbacks inside the intraday range. The target was the range high at 6713 and the outcome reached 6713 for a 20-point gain, which again confirms the tendency for ranges to revert to their opposite edge. For entry 3, the original plan was a limit by near or below the low of bar 24, which did not trigger. After observing bar 53 and its strong signal character within a bullish context, the plan shifted to a buy stop above bar 53 aiming for the top of the range or 1 times the measured move based on the range height. The outcome hit both objectives, which illustrates buying strong signal bars in a favorable context. Wednesday offered a good lesson in adapting when the first plan fails. For entry 1, the initial expectation was to buy at the open or above bar 1, targeting the previous daily high, with a protective stop below bar 1. The stop was triggered, and then a one-sided bullish trend developed, which reminds me to keep losses small so I can participate when the market reveals the true direction. For entry 2, after a large bearish bar with no follow-through and consecutive bull bars, and with a bullish higher time frame backdrop, a long above bar 5 made sense with a target at the prior daily high and a stop below bar 5. The outcome reached the target at bar 26, matching the idea that failed bears often fuel a bull resumption. For entry 3, bar 42 acted as a significant signal bar that showed weak bearish momentum after a shallow pullback. Using a trailing stop there would likely have captured profits into the final bar of the regular session, and for those who held overnight, the 1 times measured move reached 6,781 in the pre-market, which validated the signal's strength. Throughout the day the emphasis was on reading follow-through, judging whether a pullback is weak or strong, and adjusting size and targets accordingly. Thursday displayed a mix of gap dynamics and measured move rotations. For entry 1, the initial expectation was a short stop below bar 2 with the goal of closing the gap. The outcome achieved that objective at bars 11 and 13, which matches the observation that early gap closes often unfold in 2 legs. For entry 2, the initial plan was a buy stop above bar 14 looking for bullish continuation, but it did not trigger. After bar 15 closed as a bear bar with a small lower tail, the plan flipped to a short targeting 1 times the measured move. The outcome reached the target at bar 26, which underlines the importance of letting the most recent signal bar speak louder than the prior hypothesis. For entry 3, bar 29 printed as a significant bull bar and a buy stop above it aimed for a 1 times measured move. The outcome hit the target at bar 58, which shows how smoothly a market can transition from gap close and sell signals to a buy measured move once the counter trend has exhausted. The day rewarded traders who adapted to the evolving character instead of anchoring to the morning bias. Friday emphasized surprise bars and measured move precision. For entry 1, the initial expectation was a long stop above bar 2 targeting 1 times the measured move. The outcome reached that objective at bar 31, which reinforces the idea that early range extensions can snap back into a measured leg before the session settles. For entry 2, bar 42 formed a surprise bearish bar. The plan was a sell limit at a 50% pullback with a target at the bottom of the opening bar. The outcome achieved the target at bar 51, and for those using 5-minute bars across the session, the ideal target extended slightly further to around 6,762, which aligned with the bottom of the channel and provided a bit of extra follow-through. The common thread across both trades was recognizing when a surprise bar creates an air pocket and then using a mechanical pullback entry to harvest that vacuum. Managing exits near obvious reference points reduced regret and kept the focus on repeatable process. Finally, stay disciplined and trade safely in the week ahead.